And I'm expecting a net change in total employment of 180,000 on the month. Risk is skewed to the upside of a much stronger print. So if you're out there managing portfolio this morning, you're probably thinking, well, if the job market comes in a bit hot, that means yields are likely to rise. So you could simultaneously see a near-term test of 4.7, 4.75, and of course, equity markets would likely sell off on that. We're expecting a 4.2% unemployment and average hourly wage gains of 0.3% on the month, which would translate into a 4% year-over-year gain. So you've got a really solid to strong U.S. labor market, even as it slowed a bit from last month's gaudy 227,000.
Joe, it seems that no doubt there's a lot of importance and meaning around today's jobs report, but ultimately, can you take the figure at face value given the seasonality that we know usually the December figure actually includes?
That's right. So when we're thinking about that seasonal factor, that's why there's upside risk. If you're investing in the US economy, what you're seeing is a labor market that's very strong. It only needs to add between 100 to 150,000 a month to keep the employment sector stable. That's why you see this really strong gain, but we're going to continue to see the unemployment rate right around 4.2%. What you're seeing, though, is an economy that's pulling away from the rest of the world, not just in terms of growth, but more importantly, productivity. That's the magic elixir right now in the US economy. It's why it can grow faster. It's why inflation's sitting right around 2 to 2.5%. And it's why really we continue to see these strong job gains to the point where there's actually more jobs available than there are people looking for them. And that's that tight labor market that will continue to support upward pressure and overall on yields.
I would also like to understand what is the level today that could actually test the patience within the investment community. I was reading some economists suggesting that perhaps if we see a number below 150,000 later today, that is the only way where we could actually see the pressure in the bond yields actually easing. Where do you think that equilibrium actually lies?
It's right around 125,000. I would think anything below that, you'd probably get a little bit of steam release or a pressure release valve in terms of global yields. But I just don't see that. The U.S. economy is humming. We had a very strong holiday shopping season. Demand for workers continues to be stout. And my real concern here is that 5% level that you were talking about. The last time the U.S. economy breached that 5% level, it caused what we call a mini banking crisis here in the United States. Local and regional banks that hold a large portfolio of commercial real estate assets, in some cases that are non-performing, that caused the Federal Reserve to step in and ring fence those banks. That was the March-April 2023 incident. Well, we're not there yet. That is the concern, because as you take a look around the world, what did you see overnight? The People's Bank of China is slowing to, if not outright stopping, its outright bond purchases as it worries about a depreciating yen and concerns about deflation. Why? Because capital outflows to the United States through the middle of the year, get this, and I think many of your viewers may not understand this, capital outflows in the United States through June of 2024 were more than the next 12 economies combined. Things are moving quickly in the global economy. Clearly, investors are pricing risk around the world, deflation in China, inflation in the US, the UK, and economic stagnation across the European continent.